We've previously talked about the reversing of the yield curve, where you will have a longer term bond that yields a lower interest rate than a shorter term bond. And as I explained to you before, hopefully somewhat clearly, I'm never sure if I'm actually explaining these things clearly enough. Typically, if you have the option of locking up money for 3 years versus 5 years, you would expect to earn more interest when you lock your money up for 5 years because you are giving up access to the money for a longer period of time. In exchange, you would expect to earn more of an interest rate. And when the yield curve reverses, what it means is that the longer bond actually yields a lower rate. And it's a known sign of uncertainty and a negative outlook for the longer future of the economy. If you think the economy is going to be a disaster over a 5 year term, uh, you may be willing to accept a lower yield to tie up the money for 5 years because you expect that during that 5 year period, it may get even worse and you want to avoid a potentially even lower return. That's the sort of idea of a yield curve reversal. We now have a different story, which is that yesterday, briefly, and the numbers keep fluctuating, the 1 and 3 month treasury bills had yields go negative. Okay, so understand what this means. With treasury bills and bonds, prices and yields move in opposite directions. So if you've got, now we're talking nominally, imagine $100 par value bill with a 2% nominal interest rate. If I buy that bill for $100 and I get $2 for each year that I hold it, my return is 2%. And then when I'm done, I get my $100 back. For as long as I've held it, I've made 2%. Great. Imagine that the demand for that $100 bond goes up. People want to buy that $100 bond. So even though it's a $100 bond or bill, you might pay $110 for it, meaning you pay 110, you still get your 2% off of the 100, meaning your $2 a year. And then when you give the bond back, you only get $100 back. Remember, you paid 110, you get 100 back because that's the value, the face value of the bill, and you got your $2. Your interest rate, your yield has now gone down, and you have to, of course, account for the $10 that you lost, but then you made $2 a year. You can also add inflation in there and you find out your real return. When someone says, imagine that the demand went up like crazy and you bought a $100 bond for $200, it still pays 2% of the $100. You're getting your $2 a year. But when you sell that bond, when you give that bond back and you get the money back out of it, it's a $100 bond. That 2% may not have actually made up enough. You may be losing money in the net. It would be an effective negative yield on that bond. Now, that's the concept of how yields can be negative or positive. Now, what we're talking about now is something a little bit different. Yesterday, the 1 month T-bill had a yield of negative 0.01%, and the 3 month had a yield of negative 0.03%. So how is that possible? The math is that the yields can become negative if the sale price of the bond goes super high, meaning people are desperate to buy bonds. Even accounting for the interest rate, you could be looking at losing money on that bond. You will lose money on the bond. And what happened is that the Fed slashed rates to zero. So you're starting with a zero interest rate, and there is such demand for a safe haven for money that people are willing to pay to have their money held in treasuries. Instead of earning 1% for letting the government hold your money, which is normally the way it works is you give the government money, you earn something for doing that. When times are so uncertain, you might be willing to pay the government 0.01% to hold the money. Why on earth would you do this? If you believe the outlook is so grim, knowing you won't lose more than 0.01% could be better when you're talking about large amounts of money. That could be better than being exposed to larger losses if you didn't do this. One other thing, you won't necessarily actually lose money with negative yields on paper. It's important to understand that you could have deflation reach a point where the cash payments from the bond are actually worth the purchase once you account for inflation. This stuff doesn't really matter. The takeaway is the most important thing is that this is a signal about the insane level of uncertainty that there is for the foreseeable future. I think most of you probably understand that's the most important bottom line. And what this is connected to, of course, are coronavirus cases accelerating, unemployment, the future of so many businesses in the United States. And that's where I want to go next.